What if I told you that in 2025, you could own part of a rental home in New York, a luxury villa in Dubai, or even an office in Tokyo, all for just $50? This is not hype. It is tokenized real estate, and it is flipping a $4 trillion industry on its head. In our last video, we explored how tokenization is transforming global finance, from ETFs to sovereign reserves. Today, we shift from money to buildings, because owning real estate has never been this fast, this global, or this affordable. We will explore how it compares to REITs, how it protects your money, and how it is creating global social impact. If you are into fintech, crypto, or future-proof investing, hit subscribe and let us go. Tokenized real estate turns physical property into digital tokens on a blockchain. You can buy fractions of buildings, earn rental income, and trade fast, all without needing a realtor, a mortgage, or 6 figures in cash. And the best part? You can get started for as little as $50. Imagine a $1 million property. It could be a Miami rental or a Tokyo office. Now divide that into 10,000 tokens. Each token is worth $100. Buy one token and you legally own 1/10,000th of the property. You receive rental income directly to your digital wallet. No banks, no agents, no closing delays. This is all powered by blockchain technology. Blockchains like Ethereum or the XRP Ledger track ownership securely and transparently. Smart contracts, self-executing digital agreements handle everything, from title transfers to rent payouts. This cuts out middlemen and dramatically lowers transaction costs. Unlike traditional real estate, which can take weeks or months to sell, tokens can be traded in minutes. Platforms like RealT and BinaryX already offer this functionality. A January 2025 survey of 352 institutional investors by Coinbase Institutional and EY Parthenon found that 76% of firms plan to invest in tokenized assets by 2026. The market is currently worth $20 billion and projected to hit $4 trillion by 2030. In the United States, RealT has tokenized between 500 and 800 properties, covering approximately 1,200 housing units. For example, you can invest just $50 into a Detroit rental, yielding 10 to 11% annually. Payouts are in crypto, sent directly to your wallet. It is low-barrier passive income. Let us walk through how a RealT rental actually works. You browse listings, like a single-family home in Detroit. The platform shows yield, value, token price, and documents. After purchasing, you get rent directly to your wallet, usually daily or weekly. You can view tenant info, ownership records, and track income in real time. It is like Zillow meets Robinhood for fractional landlords. In Dubai, the land department launched Pripco Mint in May 2025. They tokenized a 1.75 million dirham villa, about $480,000, and sold it to 169 investors in under 5 minutes. Minimum entry? 2,000 dirhams, or about $540. It is part of a $16 billion real estate tokenization roadmap through 2033. Japan is leading Asia with over $1.3 billion in real estate-backed tokens, issued by platforms such as Securitized Japan and Mitsui's Alterna. Thanks to clear regulations and investor protections, firms like Gates Inc. plan to tokenize up to $200 billion in property, starting with $75 million in Tokyo alone. From the United States to Dubai to Japan, tokenized real estate is rapidly going global. Let us zoom out for a moment. Why are countries like Japan and the UAE moving faster? Because their regulators have embraced tokenization with licensing frameworks and digital asset legislation. In the United States and Europe, legal ambiguity slows adoption. Platforms must navigate SEC compliance, which adds cost and friction. Where regulation is clear, adoption accelerates. In 2025, inflation is still lingering around 3.2% in the US, with pockets of volatility globally. Traditional savings accounts? Still trailing behind, stock markets remain unpredictable. In contrast, tokenized real estate offers something different: real assets with real yield. For example, a $100 token in a Detroit rental could yield 10 to 11% annually. That's significantly higher than the national average bank interest rate, which hovers around 1 to 2%. But this isn't just about passive income. It's also about asset-backed stability. Unlike purely speculative crypto tokens, real estate is a tangible asset class with historical resilience. Even institutions are getting involved. In 2025, BlackRock launched a tokenized real estate fund on Ethereum and Solana, now managing over $2 billion in assets. That signals a shift. Tokenized real estate is no longer just a retail experiment. It's a serious capital vehicle. What's next? Token holders may soon use their assets as collateral, or even stake them in decentralized finance ecosystems. While that sounds promising, it comes with caveats. Regulatory uncertainty, platform risk, and technical barriers remain. Programmable property is coming, but right now, utility depends heavily on the maturity of both legal frameworks and DeFi infrastructure. Some platforms claim tokenization can help solve the affordable housing crisis. It's a compelling narrative, but not without skepticism. Ground Floor, for instance, allows investors to fund residential development projects with as little as $100. Reported returns range from 8 to 12%, while funds support new housing inventory in underserved US markets. McKinsey projects up to $4 trillion in affordable housing could be unlocked via tokenization by 2030. But critics question the true social impact. Will tokenized investment inflate property values and worsen affordability for locals? Will platforms prioritize investor returns over tenant needs? Anecdotes like Sarah, a Texas schoolteacher earning 8% annually on a ground floor loan, or Ahmed investing in a Dubai villa he may never visit, sound great. But they don't reflect the structural complexity of solving housing inequality. Tokenization is a tool, not a cure. Its outcomes will depend on how platforms balance profits with purpose and how governments regulate accordingly. There's no doubt that tokenized real estate unlocks new models. It brings global liquidity to local markets. In early 2025, DAMAC, one of Dubai's largest developers, partnered with blockchain platform Mantra to tokenize $1 billion worth of real estate. It was one of the region's most ambitious tokenization deals to date. For investors, the appeal is clear: low entry points, fractional ownership, passive income, all accessible with as little as $50. But the reality on the ground is messier. Take RealT, one of the earliest tokenized real estate platforms. It made headlines for offering fractional ownership in US rental properties, mostly in Detroit, with promised yields of up to 12%. But in 2025, RealT's entire model came under legal scrutiny. According to Outlier Media and Michigan Public Radio, hundreds of properties sold to investors through RealT either lacked clear ownership, had unpaid taxes, or were never legally transferred to the platform. Some tenants lived without leases or basic utilities. Others didn't even know their homes were being sold as crypto tokens to global investors. And RealT's troubles go beyond ownership disputes. The platform is also struggling with property management, from high maintenance costs to conflicts over co-owner decision-making. After all, when 300 people co-own a single home, What happens when the roof needs repairs? Or when the tenant stops paying rent? In response, a Detroit judge issued a temporary restraining order, halting rent collection and evictions across over 400 properties, citing widespread mismanagement and code violations. Tenant rent is now being held in escrow while the city investigates. This is one of the clearest warnings yet that tokenization without regulation can amplify housing risks instead of solving them. And the challenges don't stop at management. Most tokenized properties are only tradable on the issuing platform with limited or no access to secondary markets. If you want to exit early, you may have to accept a steep discount if you can find a buyer at all. Platforms like Archax and Zero are emerging to fill that gap, and Chainlink is building Oracle infrastructure to support price discovery and cross-chain liquidity. But seamless resale markets still aspirational. Then comes the bigger question. What happens when tokenized real estate becomes a vehicle for speculation? Multiple studies have warned that financialization of housing, treating homes as investment assets, often leads to price spikes and displacement. In fact, a 2023 report by the OECD found that rising investment by global capital was strongly correlated with declining affordability in major cities. And a 2024 white paper by the Urban Land Institute warned, without guardrails, fractional ownership could accelerate price appreciation in vulnerable markets, deepening affordability gaps. It's already happened in other asset classes. Why would housing be any different? And then there are the compliance risks. In the US, the SEC classifies most real estate tokens as securities, which means stricter disclosure requirements, investor accreditation checks, and tax obligations, especially if your rental income is paid out in crypto. So before you invest, ask the hard questions. Can I resell this token easily? Are there enough buyers? What happens in a down market? And am I really investing in real estate? Or just in a platform that owns real estate? Tokenization makes ownership more flexible, but it doesn't make it frictionless, and it certainly doesn't make it risk-free. As we've explored today, tokenized real estate is more than a buzzword. It's a seismic shift in how we own, invest, and participate in property markets around the globe. Whether you are a seasoned investor or starting with just $50, the doors to real estate are now wide open. But before you dive in, remember to ask the hard questions: liquidity, platform integrity, and market depth. Property ownership is evolving. Fractional, transparent, accessible. The revolution is happening right now. We cut through the noise with razor-sharp, data-driven precision, empowering you to craft your own insights and take confident, informed action. If you enjoyed this deep dive, smash that like button, subscribe, and ring the bell, and join fellow strategists in the StratyQ community so you never miss our next strategic breakdown. Drop a comment below. What market are you most excited to see tokenized next? I'll see you in the next video, where we decode the next frontier of business and finance.